Everybody, Marty Mazur, good morning. 21st of July 2016, your Thursday video coming to you early today because this is the one shot I have at producing it for you. You're looking at the one-year daily chart for the S&P. Notice that we're breaking a little outside this upward sloping wedge pattern, which is typical of this pattern that you break out to the downside. Doesn't have to be a big sell-off though, a sideways consolidation. For those who want to see stocks move higher this year, that would probably be a positive, although we're talking about a very short-term period of time, of course. Those of you who've been following the videos over the last few months, you'll recall the moving average convergence divergence. This was telling us back here that this rally probably wasn't going to take us to all-time highs. Then the Brexit happened, and I think we got some good washout of some issues that were kind of holding stocks back. And this is a better looking pattern going forward. So this is one reason, at least technically speaking, I've been a little more optimistic sounding of late. Another reason has been the sentiment indicators. For example, a few weeks ago, you may recall, bullishness on the American Association of Individual Investors survey was below 20%. Historically, when you get below 20%, the next 12 months tends to be very good on average for the market. As you can see, bullishness has picked up notably since then, although the average is 38.5, and we're down just a little bit over the last week. Maybe counterintuitively for some, and if you watched yesterday's TV interview, I talked about this a lot as well. You want bearishness, quite frankly. You want people not to be super optimistic. That lends itself to better things going forward. Let me show you my chart of the last 10 years of bullish sentiment in that index. Here's the recent 17.75 exceedingly low, and here's another really low period in 2016. So this other green line is the 20 mark. Last time before this year that we were below the 20% mark was in April of 2013. And let's just take a peek at what 2013 looked like for the S&P 500. 26.39% was the rate of return the last time we had a bullish sentiment indicator below 20%. The time before that was early 2009, so let's look at what 2009 looked like for the market. 2009, we had a really low sentiment indicator right in here, and look what happened in 2009. We were up 20% for the S&P 500. The time before that was 2008. So let's look at what 2008 did. So the last time we had bullishness below, wasn't quite as low as 2009, 2013, but it was below 20. We had a really rough year. So that year, individual investors got it right with a down 37.58%. So it doesn't always work, folks, although the average, as I said, is very, very good 12 months out. In 2008, if you got really bullish because sentiment was not bullish, then you did not have a good time if you jumped into the market somewhere around here when it was that low. Excuse me. Another thing I've been mentioning a lot this year about this year is breadth. And let me show you the advanced decline line. This is the number of advancers on a given day versus the number of decliners. So it really gives us a feel for, to the extent all boats are lifting with the tide. And I've got 2016. So this is something I've been pointing to a lot lately that is a very bullish indicator. This means it's broad participation in the market. So let's go back to those times when we had that low bullish sentiment and take a look at how the breadth looked and see if we can get any confirmation from the breadth. So this was the breadth reading in 2013. And one thing you've heard me say of late is that I haven't seen breadth, give you the whole year, haven't seen breadth like we're seeing this year since 2013. Remember, 2013 was a very good year for stocks, and look at that. It was a good year for stocks pretty much across the board. Remember the other time, that's most recent time previous to 2013 where we had that low sentiment indicator. That was 2009. We actually had very good breadth in 2009 as well. How about 2008 when we can go back to the other time in the last 10 years where we had such low sentiment? Well, in 2008, we did not get confirmation from the advanced decline line. Of course, it was a very bearish year, but even as we came in here, things just didn't look good from a breadth standpoint. So you weren't getting that confirmation coming off that low sentiment that said that, we despite low sentiment, we're actually seeing pretty good participation on the up days. Just an indicator that would suggest in 2008 that maybe on a short-term basis, we should not have been very bullish. And so my point here, folks, today is that, well, I don't know, of course, what the future holds. Nobody does. The setup looks pretty good. Now, I could get into, and I no doubt will in the weeks to come, relatively high valuations and how we need really good earnings to justify current prices. We're getting a pretty good earnings season so far. I've talked about things like fund manager sentiment. We just got the July survey in. Here's a look at fund managers. Sentiment is very, very bearish among mutual fund managers. These are folks that manage collectively about 600 billion in assets. This little chart here shows you the answer to the question, are you hedging your portfolio? Are you, for example, buying puts to protect for the downside over the next 3 months? And you can see it's higher than it's been in the last 8 or 10 years. You look at, let's see, risk appetite. What level of risk are you currently taking in your investment? As you can see, risk appetite among mutual fund managers is very, very low. So this is consistent with, actually more consistent with a weaker sentiment index among the American Association of Individual Investors. Again, these are professional managers. To what extent are you overweight or underweight asset classes? Huge overweighting in cash, so lots of liquidity on the sidelines. Somewhat overweight now in U.S. stocks, still an overweighting in bonds. Huge underweighting in equities overall, and in the other parts of the world that I talked about last Sunday night in my international investing video. As you can see, global stocks have a pretty noticeable underweighting, and quite frankly, I like that. This is when these positions come back to normal, when we revert to the mean, that means these stocks get bought. This is not a huge overweighting in U.S. stocks, but it's not as bullish as it has been of late. And then let me just kind of close here with a couple other, I think, indicators or data points that speak to sentiment in the world. The PDF you now have in front of you, the gold to S&P 500 ratio. See to the far left, the beginning of the year, gold really spiked up in price and really outperformed stocks. And on a year-to-date basis, it has quite measurably. But notice towards the right there, notice the breakdown. Gold, in my view, this big rush up has been really concerns over the global economy. Brexit boosted the price of gold. Just for a moment, the Turkish failed coup boosted the price of gold. It's kind of rolling over a little bit. I chart gold as well as other things. The technicals for gold, in my view, are breaking down, but there's still a tremendous amount of bullishness. If you look at the commitment of futures traders, they're still very long gold. So it'll be interesting to see, but the fact that the price is breaking down a little bit lately versus the S&P suggests that there may not be quite as much Armageddon fear in the market as there was, say, to start the year. Another indication of a shift in sentiment is the chart you have in front of you. This PDF is for utilities, XLU, the ETF that tracks the utility sector index versus the S&P 500. Again, early in the year, you can see it spike. A lot of people have been chasing utility stocks because they pay a very attractive yield. And of course, fixed income rates are in the gutter. So there's that story that, it's yield chasing. Of course, it's pushed valuations very high, historically speaking, for utilities. But it's also the fact that utilities are viewed as a safe place to hide during slowdowns and so on. So it looks very much like the gold chart. You look to the right, you see the utilities relationship to SPX begin to roll over, meaning more cyclical, more growthy sectors seem to be outperforming utilities, which is another sign of a positive shift in sentiment on the economy and on the prospects for the market going forward. So in a nutshell, folks, my message of late and my explanation for why we've pushed through all-time highs and we seem to be kind of holding our own up there and maybe potentially gaining a little momentum going forward is primarily because folks came into the year feeling like the folks you see on the screen. When you feel that way, you hoard your cash. And then suddenly, when you realize that the world has not come to an end, and maybe cash isn't the best place to be, you begin feeling better about things, and to overcome that fear of losing, you move in the other direction, and that moving in the other direction forces you to buy stocks, and that pushes the market higher. And we're probably somewhere between the folks huddling under the umbrella with the storms brewing and the folks you see here on the party bus. The sentiment indicators do not suggest that we're partying quite that hard just yet. And when we are, I'm going to be sounding a very cautious tune on the market. I'll leave it there. Thank you, folks, as always, for watching and listening, and look for the weekend update over the next couple of days. Take care.